Good afternoon, and thank you for joining us today. I'm Taylor Combaluzier, a mining analyst at Red Cloud Securities. Today's webinar features EDM Resources, which owns the Scotia Mine Zinc, Lead, and Gypsum project near Halifax, Nova Scotia. The Scotia Mine is a brownfield permanent operation with a fully built mine and mill with near-term, low cash cost commercial production. Today, I have with me on the webinar Mark Haywood, who's the President and Chief Executive Officer, as well as a Director at EDM. The format of today's webinar will be comprised of two parts. In the first part, Mark will provide an introduction to EDM Resources. He'll outline the highlights from the recently completed PFS and the upside exploration potential at the project. In the second part of the webinar, we'll take your questions live. So please submit your questions using the chat and we'll get to as many as we can. I'll note that you can type them in at any point throughout the presentation. To start, we'll handle the disclosures and then we'll dive into the presentation. So for EDM Resources, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of the EDM corporate presentation located on the company's website. For Red Cloud Securities, Inc., I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. And we note that this call does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research located on our website for EDM-specific disclosures. So with that out of the way, I'll turn it over to Mark to give you an introduction to the company and what you have to look forward to in the future.
Great, thanks Taylor. And thank you for hosting EDM on your channel. So to start off, EDM, Explore, Develop, Mine, that's our focus. We have a mine in Nova Scotia, which is permanent and fully built. And most people know that Nova Scotia is a tier 1 jurisdiction. And that recently we announced that the company has been financed to commercial production to the tune of roughly $24 million US. And we're a near-term commercial production opportunity for investors with a long life of mine and a low C1 cash cost. Taylor mentioned our forward-looking statements. Of course, we are making a number of those and in our path towards commercial production next year. And of course, I won't go through this in a lot of detail, but you have it there to read at your leisure. Some of the investment highlights in the last 12 months or so, I'd like to highlight principally that this company is very undervalued, trading at about 10% of its NAV. It's a significant opportunity for investors such as your audience to consider what I'm presenting and to see that this is really a once in a lifetime opportunity as we see it and the company sees it. In terms of our major developments, we recently announced the completion of securing a competitive offtake on the zinc and lead production with IXMSA. They're a Geneva-based group. And we also, dovetailed with that, we secured attractive project finance for the project. And that finance is $24 million. And that gets us through to commercial production. So the Scotia Mine in Nova Scotia, near to the airport and within the HRM jurisdiction, is fully owned by EDM and our 100% owned subsidiary. As I mentioned, this is a tier 1 mining jurisdiction. We have 43,101 mineral resources and mineral reserves on lead, zinc, and gypsum. We completed so far 2 pre-feasibility studies, and the last one was completed in November of last year, and that had incredible economics associated with that project. An NPV at 5% of over 225 million Canadian, with a pre-tax internal rate of return of 69%. So one of the reasons why that number is so good is because the mine's built and permitted, and we just need a small amount of capital, which is $31 million, to advance the project to commercial production within 9 to 12 months of that. We did that. We announced the financing and the capital required to put us into commercial production. and that is geared right now for Q4 of next year, 2023. In terms of the opportunity, a long strike for the mine to expand, we have a number of extensions on the mineral lease, and we also have a number of prospects which are hosting zinc and lead and potentially gypsum near the mine and within a short trucking distance to the mill. So our plan right now for the remainder of this year, 2022, 2023 next year, is the recruitment of key personnel and ordering a number of different long lead items that we have earmarked and determined that it would be good to order well in advance of their need on site, considering supply issues at this stage. So we're working through some of those, and we expect to order those 2 or 3 lead items in Q4, this quarter. We also plan to complete a number of different condition precedents associated with the credit agreement with IXM and close on the project finance in Q1 of next year. That's assuming that the market stays up there and other things, of course, namely the prices and our updated internal numbers to show that the robustness of the project continues, which we're doing right now in terms of updating the Komatsu prices or Caterpillar prices for mining equipment and other equipment for the mill to make sure that we've got a very good handle on the changes that have taken place in the last 12 months since the last pre-feasibility study. So with all that in mind, our plan is to commence mining in Q3 of next year for commercial production some 6 months later in Q4 2023. In terms of the team, very important that a mining company has a very experienced board of directors who are experienced particularly in the natural resources industry, and of course I'm happy to convey the message that we have a very highly experienced corporate governance group of directors, and we provide some of the details on those directors towards the end of this presentation. But just as a highlight right now, very experienced directors. In terms of the company management, EDM has a lot of experience in mining and managing mining companies. I myself have over 15 years managing exploration mining companies on TSX and Adventure. Our CFO has over 25 years in the mineral resources industry and also previous experience on the exchange that we're listed. And of course, the Scotia Mine has a growing number of professionals on site and in Halifax. I'm also based there most of the time, and I have a lot of mining experience, over 15 years on the mine site and operational roles, and our mine manager has over 25 years of mine site experience. We also have a number of other junior and ongoing senior staff who are starting to join the company in various positions, so we're actively recruiting some key members of that to build out our professional team on site. In terms of where we're located, all our projects are in Nova Scotia. You can see the star here on the screen. The Scotia Mine is very close to the CN rail network. We're about 8 kilometres actually from a siding, the Milford Station siding. We're also roughly 30 kilometres from the Halifax International Airport, and from the downtown Halifax city centre only 62 km. We also have a number of different prospects nearby the mine: Carroll's Corner, which is along the strike of the mine; Eastville, which is a short trucking distance; and we have Enon Loch Lomond up in the Cape Breton area. It's also very prospective, and we're actively working these prospects as well as a potential mill feed to the mine or as a standalone project. In terms of the overview of the mine, as I mentioned earlier, we're 100% owned by EDM. The mine's 100% owned by EDM through its subsidiary Scotia Mine Limited. We have a large land position. We have mineral leases and exploration licenses, as well as processing equipment. And importantly, EDM owns the land associated with the mineral leases. We don't have any First Nations issues, and we have strong community awareness, very important these days. We're actively engaged as part of our growing ESG framework on the local community and, of course, the First Nations. In terms of royalties, there's a very small royalty to the government of Nova Scotia in the order of 2% NSR. We have 1% gross metal royalty to Globex on an exploration license, which is often toward the end of the 14-year mine life of the project. In terms of the economics of the PFS results, these are the recent results of November 2021, which we're currently updating internally. As I mentioned before, very strong NPV at 5%. Of course, at 8% now, we're looking at over 174 million as pre-tax, and the internal rate of return 69%. So a very short payback of roughly 1.5 years on the credit for the 14-year mine life. So it's a great earner. Small capital costs of roughly $31 million, which including $2.7 million contingency and some working capital. And that effectively for the project creates a very robust project with a very low cash cost, C1 cash cost over the life of the mine for roughly 50 cents a pound. That's on the average. So with the zinc price currently over $1.30, and last year and the year before 2021, on average it was over $1.50, and I think it reached over $2. There's a very strong margin between the commodity price and the cash cost of the project. In terms of what's there, existing infrastructure is extensive. We have workshops, warehouses, storage facilities, tailings ponds. These are all permitted. We also have power from the regional grid and water from wells and a nearby river, which is also licensed too. And importantly, we also want a railway siding. And not only our logistics are close to Halifax and the support from Dartmouth and other areas, other local areas to Halifax, but we're nearby Deepwater Port, nearby the rail line, and so we can ship our concentrate in a number of different methods to the market. In terms of commercial production, we have permits in place for the start of operations, and we've been actively working on those for the last 3 years since I took over to get them into full compliance, and we're happy to say that we are in that position right now. We have 2 environmental approvals in place and the industrial approval to commence production within 90 days notice. There's a few things we're working on, part of that credit agreement we have with IXM, but we plan to be in commercial production as soon as Q4 of 2023. In terms of the site layout, most of the foreground, as I mentioned, is owned by EDM and a subsidiary Scotia Mine Limited. There's our access road coming in from an all-season highway to the fully built plant, offices, warehouses that I mentioned before. You see a pit that's got water in there. We're extending and doing cutbacks along strike of that pit over the 14 years and extending onto the green area you can see in the background. So essentially the mine is a 14-year mine that's open pit or open cut operation with a low cash cost and a low capital cost to get into production. When I took over, we completely had the mineral resources redone. We used SIK to do that, and that essentially increased the resources by roughly 3 times. My predecessors had a smaller resource, and there was some opportunities to improve upon that with some of the drilling that was done, but essentially bring it all together. And what that did is gave us roughly 30 million tonnes of measured, indicated, and inferred material, of which 25 million tonne is measured and indicated. It's not a high grade. On average, we're roughly 3% zinc equivalent, but this is an open pit operation, with very good logistics, close to Halifax, close to rail, as I mentioned. So the operating costs, the cash cost is quite low, and that's what we determined through the process of doing the PFS. So the mineral resources, in terms of converting the resources to reserves, that's what the PFS achieved. And that resulted in the first ever 43-101 mineral reserves on the project. So from 25 million measured and indicated, we cut that back to roughly 14 million tonnes of proven and probable material at a cut-off grade of roughly 1.5% zinc equivalent, which the net result was an overall head grade, mined head grade of 3.09% zinc equivalent. That was determined on the economics of the zinc and the lead, and as some of our listeners might know, that we mined through gypsum in order to access the zinc and lead mineralization, which is hosted in limestone. And so that gypsum was in the past was just cast onto the waste pile. So we did additional work on the gypsum, and we announced a resource for that of roughly 5 million tonnes, and then we converted that into a reserve. So the recent PFS actually added in approximately 5 million tonnes, as you can see on the screen here, of gypsum reserve to the economics of the project, which essentially added around roughly $30 million of net present value to the project. So that made the project even more robust on top of the first PFS we did. And that updated PFS, we also included additional inflation and other costs associated with the project that we knew in November of last year. So the update we're doing now on the economics is to get essentially closer to the capital cost of target of $31 million by fine-tuning some of the costs that we allow for in the PFS, and eliminate some others that we don't need or hopefully are going to be eliminated through that process. One of those, of course, is the contingency. In the $31 million capital cost, we had $2.7 million contingency, and so we're working on reducing that, and perhaps through that process we'd actually overall reduce the capex. But at the meantime, we're looking at all those opportunities from improving, upgrading the ore, potentially ore sorting, various suppliers, and some of those, as you can imagine, due to the inflationary measures out there, that's going to be impacting on that. But we're working very closely with IXM to determine that number, and of course determine exactly when we're going to start. Also, you can see on this slide here, on the bottom two images, the left is the ultimate pit design, and virtually all of that is permitted, except for a little bit on the northeast end. Probably can't see my cursor, but just in this area here, there's a small section that needs to be permitted in the future. But as you can see, the majority of the pit is permitted and ready to go. On the right picture here, these images, different colors, are showing the development of the pit. Essentially, it's a cutback situation where we mine in the blue and in the yellow zones first, and then we do cutbacks on either side of that to achieve the overall 14-year mine life. In terms of the overall life of mine plan, these images here, you can see that we're essentially mining 13 million tonnes, we're processing 13 million tonnes, essentially 1 million tonne of processing a year, 56% concentrate of zinc, and 91% concentrate of lead. And that's also, we're mining the gypsum, and we have an offtake with the gypsum as well. And so we'd be selling that 5.2 million tonnes to a supplier or buyer in Nova Scotia. And gypsum price, for some of the audience out there might know, that that's increased recently. for crude gypsum, and it's roughly $10 a tonne. The overall project has a strip ratio of 7.1, and you can see from these charts here that ore processing head grade for the zinc and the lead fairly consistent in terms of tonnage, but we have a drop-off in the forward years of year 6 onwards in the zinc, and that's an opportunity to bring some of our neighbouring prospects mineralisation into the mill, which would present an opportunity of further improving the economics of the project. This other image is essentially, the top right is a stockpile. So I believe in disconnecting the mine to the mill, making sure that the mine has sufficient material ahead of it to provide comfort that the mill can achieve its consistent 1 million tonnes a year of processing at a certain head grade, which is roughly 2%, 2.5% zinc. So the resource and the reserves are very closely matched to the capabilities of the mill, and that's why we only needed $30 million to put the project into production. For the next slide, you can see the layout of the project. This has been designed, and it's actual working pit designs and waste dumps, and you can see that we have an ultimate pit designs, the main zone here. We have a northeast pit, and we have another couple of satellite pits off in the future. These pits over here need permitting, and we expect to do that after we're in production. Most of the permitting takes upwards of 3 years to do, so we'll be starting these fairly early on, although we don't need them until year 10 or year 9 onwards. Some of the highlights of the PFS, this is just essentially a processing flow diagram to show that it's a conventional crushing, grinding, flotation and dewatering process of the operation, and that's essentially a flotation circuit that wins the predominant amount of the mineralisation out of the grinding circuit. So what we're doing here, most of that is in place. We're upgrading some of the crushing circuit with new equipment. The existing grinding circuit is in pretty good shape, but we're upgrading pumps and adding in the latest cyclones. In the flotation circuit, we have Denver cells, which are fairly old, very manual. We're looking at adding in additional cells, Jamison or alternative recovery cell on the flotation circuit or for the zinc side to improve the recovery of the zinc. And then, of course, in the dewatering circuit, we're adding in filter presses to remove the water from the concentrate, and then the net result is to deliver concentrate into shipping containers or bags of either lead or zinc, and that goes onto rail or down to Fairview Cove or onto truck or to wherever the off-taker requires it to be delivered. So we'll work closely with the off-taker and to ensure that we're getting the maximum return on that concentrate, but also the highest quality in terms of achieving the best revenue for the concentrate using IXM's marketing skills and using the containerized system to ensure that the quality doesn't degrade through that process of transporting from the mine to the smelter. Importantly, though, most of the equipment is in place, and so in the pre-feasibility, we've factored in the cost to update some equipment, replace motors or pipes, and add in additional modern equipment, but still the same conventional flotation. In terms of the PFS highlights, I mentioned before it's a low cash cost You can see here 51 cents a pound over the life of mine, which the lower graph shows us that we'll be one of the lowest cost producers in the world. I won't go through the PFS highlights in detail, but very high NPV of the project, very strong internal rate of return of over 69%. That's virtually unheard of these days, which is an after-tax return of 65%. Payback period on the $31 million loan from IXM is roughly 1.3 years. And the other point to note is that our processing rate of 2,700 tonnes a day, roughly 1 million tonnes a year, is matched to the mine and the mill in terms of upgrading the equipment. Could it go higher? This is always an opportunity that we could improve the throughput, improve the head grade delivered into the mill from the mine, and of course improving the flotation circuit to maximize the recoveries from the zinc and the lead. The other point to note is that on the recent PFS, the average zinc price that we used was $1.22. As I mentioned earlier, in 2021 and up to April of 2022 this year, the zinc price has been over $1.50 and has tracked up to $2 a pound, whereas in the PFS we only used $1.22 on average. So with the current prices now sitting around about $1.34, we still have more revenue than is shown here in terms of net present value. So if we did the study right now, based on the current prices, then the NPV of the project would be improved. However, with the changes in economics on a range of different variables from, I guess, the cost of diesel and other aspects of operating a mine, labour, and just the general increases of prices, you'd expect that to probably level out, which is why we're doing an updated internal study right now and looking at the long-term prices with our offtake partner, who have obviously a very good feel on that. The gypsum crude price, as I mentioned before, it's around about $10 a tonne Canadian. That's also improved. So the economics in terms of metal, lead's come down a bit, but zinc and gypsum are much better than what we included in the PFS. Also, because we're sending the concentrate to the smelter, we have to consider the treatment charges, or TCs, and they've come down considerably since we did the PFS as well. So that's also helping the project. Not to mention the exchange rate, a strong US dollar exchange rate, which we're seeing now, is actually good for our project. So the economics, I think, with our internal study are going to improve, and we are working with our off-takers on that. In terms of ESG, we have a community social government framework, which we're adapting over to an ESG framework. We have the environmental permits in place. We have low additional land impact going forward due to our existing setup and infrastructure. We have power from the Nova Scotia electrical grid. We have site water treatment on site if we need it. But these existing facilities and water management controls put us in a very low impact to the environment going forward. The mine is built. All we're doing is upgrading some equipment. We're keeping the same process, and we're an open pit operation. So there's a very low risk of environmental failure. The tailings pond is not acid drainage producing, and it's a valley style filled pond as well. So it's stood the test of time already, and it's not failed. So we don't expect any environmental issues to be a problem, but we're monitoring this. We're very advanced in terms of monitoring all background field work for the last 10 years since the company acquired this project. We do weekly monitoring, extensive monitoring, which costs about $40,000 a year roughly, to make sure that we're having very minimal impact. And as we go forward into commercial production, that we have very good controls in place to monitor that, and of course report that to our stakeholders. In terms of our social framework, we have and are developing community awareness programs. We held our first community awareness open day, if you like, a couple of weeks ago. That was well received, I believe. We had roughly 30 people attend, and we're going to continue the approach of engaging with the community, engaging with First Nations, to ensure that they're well aware of the project. And of course, the employment in the area, particularly for HRM and Nova Scotia areas, there's a lot of jobs. It's a good opportunity for the community to be involved in that. So we have strong government support because of being in Nova Scotia and close to Dartmouth and which is industrial area, if you like. We can tap into a lot of Nova Scotia suppliers and contractors. That also creates an opportunity for diversity of employment, and so being regional, very close to the airport I mentioned, we can have employees who live in the region and raise their families there and also work at the mine. So that's a great opportunity, I think. In terms of governance, we have an independent board of directors. As I mentioned earlier, a lot of these gentlemen are experienced mining people and experience in the natural resources generally. And so we have a corporate governance manual, which we put in place a number of years ago, which has internal controls to promote the transparency and, of course, leadership accountability going forward. So we're developing our framework, as we speak, and we're going to formally implement that as we get closer to commercial production. In terms of the mine infrastructure, I've mentioned a little bit about this before, but there's incredible amount of infrastructure in place right now, and that's due to the age of the mine. It was first built in the 70s and 80s and operated as an underground mine, which is where it gets its reputation, I think, as an underground operation. We're an open pit operation now. It's a low cost development opportunity for the project to advance through open cut for 14 years, and we don't need to go underground. And that means that we can process all the ore and make considerable revenue for the region over 14 years. So this is the important infrastructure that's just been sitting there, and our plan is to put this in production next year and use the predominant amount of infrastructure and just update it, and hence the low capital cost. As I mentioned, in terms of the infrastructure, logistics is very important. We're an all-season highway system. It goes right past our mine gate. We're on the Nova Scotia grid. We have water rights and licenses, and of course we're near all-season deep water ports. In terms of exploration upside, we had the large map at the start showed the development potential for some of our prospects in Nova Scotia. But importantly, we also have on strike opportunities down to Carroll's Farm, and just I guess neighbouring our project, our mineral lease, which you can see here in purple. So we have a number of different prospects that are surrounding that that could potentially provide mill feed in the long term to the mine to potentially extend the 14-year mine life. So we'll look at that in due course. At the moment, we're focused on completing the credit condition precedents to get into commercial production next year using the existing mineral resources and reserves that we've defined into 43-101 standards. In terms of our other zinc explorers and developers, it may be hard to see, but most of these companies here, they have market caps and share prices well above us, and they don't have a mine, mineral reserves rather. So in terms of them, we're considerably undervalued, and it's an opportunity that we're working on to improve the profile of the company now that we're financed, and to essentially bring us back closer to where the other companies are. And that's why we've begun our drive for IR marketing, particularly with joining our forces with Red Cloud as we work through that process. So we're 10% of our NAV, so that represents a great opportunity for would-be investors to participate and become a shareholder, and as we advance this project to commercial production. In terms of summary, I won't go through this in detail, but essentially we have the offtake. We're trading well below our NAV, which represents an opportunity to be an investor. The mine is financed to commercial production. We're going to do some additional funding in terms of equity financing soon to help ensure that during the startup phase we don't run short of capital. And so I think that's a very important aspect to have. You would realise that during startup, it's a very critical period, and so we'd like to have at least additional $5 million in the treasury for contingency in the event of things are delayed just during that critical startup period. So we're working on that. And of course, additional information, the directors and management, as I mentioned before, we have a very competent team in place right now between the directors and myself. This is a great opportunity for value to be created using some of the experience of these directors. And of course, the management team, which we're building as part of the development of the mine site's key personnel. In terms of permitting, we are a permitted operation. We're not fully permitted because we have additional 4 years on the back end of the project that we're looking to permit, but we are permitted for roughly 8 years if we were to start now. We have one of our EAs just waiting on an approval for a date extension from the government, Nova Scotia. We're expecting that soon. Once that's one of our condition precedents for the financing offtake. Once that's in place, with the other condition precedents in terms of the offtake, then we will be pushing the button and have a firm timeline about when the project is going to be in commercial production. At the moment, all those aspects are pointing towards Q4 of 2023 next year. Just a snapshot of some of the existing assets. You can see we have an open pit, we have flotation cells in the mill, we have all-season access roads. The mill is essentially a 4-story steel and concrete building that's massive, with all the processing equipment contained inside. That's sufficient, it's permitted for us to produce concentrate over the 14 years at 1 million tonnes processing rate. Other assets you can see here, just an indication that this is a fully built mine, it's permitted, and all we're doing is essentially upgrading it with new equipment and putting it in production. In terms of commodity outlook, zinc has come off a little bit, as I mentioned before, from the $2 high of 2021, and it's tracking about $1.34 now. Lead is also down a tad as well, and of course the exchange rate has been sitting around about 75 to the US. So those major parameters, of course, affect the project, but it's still a very robust project, from a C1 cash cost of 50 cents up to the commodity price sitting, well above our pre-feasibility study, and of course where it is now at $1.34, I think today. We expect that to improve with everything that's going on in the world. This is, of course, a mine with a very low risk and very wide margin. In terms of EDM, uniquely, we only have roughly 20 million shares outstanding. Don't have any warrants, some RSUs and some options. So fully diluted, we're about 21 million shares outstanding, and which represents only a market capitalization of 10 million. As I mentioned, the disconnect between the price to net asset value is enormous here. And this represents, we believe, an opportunity for investors to be involved in a company that is permitted. We're financed to commercial production, and we're working through now in terms of communicating that to the market and putting the mine in production as early as Q4 next year. In terms of our final slide, you can see here, financed turnkey operation. We're headquartered in Halifax. The mine is located in Cooksbrook. This is essentially our community, and we have contact information that is easily reached if any investors or community would like to contact us. So Taylor, that's essentially it in terms of the presentation.
Perfect. Thank you very much, Mark. So now we'll turn to the Q&A portion of the webinar, and just a reminder to everybody on the line that you can type in your questions at any point. We have had quite a few come in, so I'll just kind of start off here. First one, can you comment on the impact of the recent Hurricane Fiona and how that size of storm could be handled during production?
The eye of the storm essentially missed the mine, but we had strong winds, and in the region of Halifax, of course, and as the storm headed up towards Cape Breton, we had trees down just all over Halifax region and Cooksbrook, and that affected the power to the mine. And so we lost power at the mine for a number of days. I think there was about 4 days. We do have generators, so backup generators on site, and going forward to commercial production, we plan on putting some compressed natural gas generators on site. So they're very green-friendly generators rather than diesel backup systems. And the airport, Halifax Airport, uses the same system. So that would enable that plan is to put those generators on site to generate 2 megs each, and that's sufficient enough to run the mine, run the plant. So very minimal damage to the mine. In fact, no damage to the mine. It's only trees that affected the power to the mine.
Perfect. Okay. Next question here. Can you describe the fleet condition and how much or how many new acquisitions and would you have to make, and what would the lead time be on that?
In terms of which, the fleet?
Yes. Yeah.
Yeah. So in the PFS, the first one, we determined that we would use Komatsu equipment. That's roughly 10 trucks, 2 excavators, graders, dozers, and other support equipment. So in the updated PFS, we switched over to Caterpillar, roughly the same kit, comprised of the trucks, the operating conditions, the soft ground in fall and spring. And so we split the fleet into hybrid of 40-ton trucks and rigid frame 70-ton trucks. So not a big fleet, but it's our sister operation, if you like, just down the road, Moose River. It used to be called Atlantic Gold. They use a very similar equipment, and it works very well. Our neighbour, directly neighbour on strike, National Gypsum, the largest gypsum mine in the world, uses the same fleet as well. So we're very confident in our fleet selection. We did a lot of calculations. actual calculations. I myself am a mining engineer, and I saw a part of that as well to put my 2 cents worth in. But it's not a big fleet. In essence, we have about 150 people on the mine site engaged as employees, and roughly, I think it's a third of that is the mining workforce.
Okay, perfect. And I guess on that note, we did have another question, just wondering, just let me find it here, how many people would be employed during the preparations and then during the life of mine?
Mm-hmm. Yeah. So when we're starting up, of course, we're spending roughly $30 million in the area, and a lot of that would be through contractors, and of course the first 5 months of mining before we go to commercial production. So during that startup phase, if you like, there would be a considerable number of people indirectly that the company will employ. I don't know exactly how many of that would be, but because it depends on the contracting, but essentially during commercial production and our own personnel would be roughly 150 people, full-time people, for the life of the mine, and that's of course the direct employees.
Right, perfect. Okay. So we have another question here. Start off with a comment. It says zinc TCs were about $150 last year. They've jumped up to around $225. This person's just wondering what the zinc TC that was used in the 43-101.
Mm-hmm. So the beauty about a commercial offtake agreement with IXM is that that arrangement is essentially based on spot, and so spot prices, particularly on metal prices and on TCs, have performed much better than benchmark prices. So as spot prices fluctuate, we've seen in between $90 a ton to $150 a ton in terms of benchmarks. So on average, we've seen the margin between metal price benchmark and TC benchmark being pretty close, but spot prices have been wider, and that's one of the reasons why we signed up with IXM, is because the spot prices have been better and have performed better under the TC basis. Importantly, though, treatment charges are related to essentially an average quality of concentrate. Our concentrate is well sought after. It has almost no deleterious materials. There's only a little bit of cadmium, which is 0.3%. I think it's 0.3% cadmium, which means it's restricted from going into China currently, but they're looking at changing that. But other than that, it's got no deleterious materials, which means that it's a high quality concentrate that can be blended with another operation's concentrate at the smelter, which would attract a higher price for our concentrate. So essentially, out of the margins and the penalties, we have virtually no penalties on our concentrate, which improves the margins. So that's another aspect of a lot of people don't know about our concentrate, because it was mined in the past, that it's well sought after, and so we had no trouble essentially in negotiating very good terms for the offtake and for the finance, because this concentrate is well known and because of the lack of penalties associated with it.
Right, perfect. Mm-hmm. So another question here, can you please talk through your financing strategy for the equity portion of your capital raise? What's your ideal scenario there, and backup plans, and any conversations?
Okay. Yeah. So when we were negotiating with the offtake with a number of different groups, and we settled on IXM, part of their startup and part of contingency, as an operator myself, I like to make sure that we de-risk the project as much as possible. And one of the ways of de-risking is to ensure you have more capital than you need. And so we negotiated a full financing for the project. But the company and our board of directors, as I mentioned, who are very experienced in this area, we agreed that we would put in an additional 5 to 10 million into the treasury of the company prior to commercial production. So we included 5 million of that as a condition precedent. So our intention is to improve the profile of the company now that we have the credit agreement in place, improve the profile of the company, and then seek the minimum amount of 5 million up to at least 10 million or so, depending on the economic and market conditions out there at the time. So how are we going to do that? Part of it is that the project attracts flow through in terms of commercial development expenditure, because we're stripping for 5 months, waste stripping for 5 months, which is essentially about $7 million Canadian. And so we could use flow through for that, or we could use hard dollars for that as well. But it's just an opportunity if it made sense on the financing arrangements. So in a nutshell, we'd be looking for between 5 and 10 million, or maybe 12 million. And we've been working with a number of different brokerage groups to discuss how that would look. Could be a combination of flow through. What are the use of funds? We can order some equipment ahead of when we plan to draw that down from the off-taker in terms of the finance. If we do that in advance, then we de-risk the timeline. And that's why I said, while we wait for the funds to be raised, and we're actively pursuing that, of course, with a number of groups, there's some long lead items, and that's about $1 million that we could raise and allocate towards acquiring certain equipment. And one of those pieces of equipment is the filter presses, which is a 52-week delay. So I guess what I'm saying is, between now and the end of the year, our plan is to ideally raise between 5 and 10 million through equity issuance.
Right, perfect. Okay. And then we have another question, switching back to the technical side of things here. Does the pit have to be drained, and what would be the timeline if so?
Yeah, good question. A lot of people ask me that. What are you going to do with that lake? It's going to take ages to pump out. Essentially, if we were going to pump it out starting tomorrow, it would take three months. But we don't want to do that, and we do not need to do that. There's a couple of reasons. The first reason is you need to pump down slowly in order to stabilize the existing walls, and that's essentially over a longer period. So we wouldn't want to do that over a 3-month period. Secondly, we don't need to mine down the bottom of the pit because that's already been mined out. So we're actually mining along strike. So we're doing a series of cutbacks along the northeast extension and the southeast extension. And what that does is, while they're mining in those areas, that's part of our 2 fleet. One fleet is in the southwest area. Other fleet is in the northeast section. They're mining that down. We can be pumping that down, pumping the pit down. So essentially, when we start mining, after 2 months of mining, essentially, we will start lowering that pit slowly. And we would like to use that water, most of that water, in the mill to test the mill, to make sure the mill's operating essentially without mineralization, but pumping, and we plan on using that water for that purpose. So it would be a gradual process of taking the water out of the pit. You can imagine it's got mud in it. We're not even essentially mining in that area, so it's just really the extensions of the pit that we're mining, and that's why it has a minimal impact on the operation.
Right, perfect. Okay. So I think we've gone through all the questions here that have come in, and we're coming up on about an hour. So I think we'll leave it there. So I would like to thank Mark from EDM Resources for taking the time to host the webinar today with Red Cloud Securities, and thank you to everybody on the line for tuning in with us.
Thank you, Taylor.